When it comes to your retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated just like a number. This is your retirement. So it's time to think differently. And you're in luck because you've found the Retire Your Way podcast with ILG Financial. At ILG Financial, you won't find generic, run-of-the-mill plans containing the same old cookie-cutter solutions. Dave Chase and the ILG Financial team focus on building one retirement at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hats and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now.
Welcome to the Retire Your Way podcast with Dave Lopez. I'm Rod Stutz. When it comes to retirement, you want to have the same old plan everybody else has? Of course not. You're unique. You have your own goals and dreams. Don't be treated just like a number. This is your retirement, so it's time to think differently. And you're in luck today because you found the Retire Your Way podcast with ILG Financial. At ILG Financial, you won't find generic run-of-the-mill plans containing the same old cookie-cutter solutions. Dave and the ILG Financial team focus on building one retirement at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hat and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now. We have a lot of interesting things to talk about today. A theme we often discuss on this podcast is often the idea that you don't know what you don't know. And I think that in this rising tax environment, you realize this could not be truer, especially when you're moving towards retirement where your income, expenses, and everything is changing. Today, Dave Lopez is going to walk us through an example of a couple that, for all intents and purposes, thought they were set up pretty well for retirement, and then see how much was going on behind the scenes that they were not aware of. And Dave, first of all, how are you?
I am doing great. I think these days, and it seems like we say this all the time, but I think of that Chinese proverb of "May you live in interesting times," and they say, "Is that a curse or a blessing?" And I guess it depends on how it all ends up, right?
Yeah, and we're living in interesting times. There's no question about that. I mentioned a while ago that you don't know what you don't know. What in the world are we talking about when we say that?
Yeah, so a lot of times this is a phrase you hear at the office all the time, is be careful if you don't know what you don't know. And what we're talking about is take a typical couple getting ready to retirement. They've got a list of things that they know to look out for. I've got a plan for long-term care. I've got a plan for living too long and running out of money. Things like that. That's the things they do know, right? But
right.
Are there things you don't even know to ask about? And that's what today's going to be talking about. Here's some risks that may be out there for you, or maybe not even a risk, but things you could do to improve your situation, but you don't even know to ask about them, so you certainly don't know whether to consider implementing them. I don't know what I don't know.
Well, on today's show, you're going to get some answers to your questions, but also get some answers to some questions you maybe did not even know you needed to ask. So let's start here and talk about this couple that you mentioned and tell us what their situation is and what they need to be thinking about.
Yeah, so today we're going to use just a hypothetical couple to go through this example. And Ron, I'm tasking you to keep me on track here so this doesn't turn into a 1-hour podcast, right? Because I'm going to have to give some numbers to set the scene, but I'm going to try to do big picture. So for those of you who are listening, if you think I'm either going through some of these numbers too fast or blowing over a number here or there, don't worry about that. It's just a short podcast focus more on the big picture than the individual numbers. Fair enough?
If I start to get lost, I'll try and get myself back on track.
I know. That's why I love doing this with you. You're the one the voice of reason when I get off on my math tangent that you say, Dave, no one can understand you anymore. So I'm counting on you, Ron.
Nobody else has ever called me the voice of reason, but go ahead. I appreciate it.
All right, look, let's jump right into this hypothetical couple.
Okay.
They've got plenty of money coming in. They've got a pension coming in. And between the money they've got saved and the pension, they think they've got it all figured out. They're going to have enough money in retirement, and they probably will. You'll see that. Mm-hmm. But they think they've pretty much got everything planned for, and there's nothing much more to do than to have the money invested. So what we're going to take a look, we're going to walk through today with this couple is we're going to walk through their initial plan, how they're set up now. Then we're going to talk about some examples of some missing information that they don't even know about to address.
Okay.
And then we will go one step further and saying if they address these, here's a couple ways they could address these without really changing any investments, right? Mm-hmm. Or any returns. We're not saying you can get a better return. Nothing else changes, just a flip. We're moving this over there and this over there and showing the impact it could have on them and their heirs. Sound good?
Yeah, sounds good. And I know that you talked about this couple, having a pension. So why don't we start there and rely on that pension for income?
Yeah, so that's a great one because we don't want to assume everybody listening knows. Most folks these days don't have pensions, right? Back in the day, mm-hmm. that everybody had a pension, and then we switched the 401k IRA system, and pensions started to go away. Now, federal government still has them, state governments have them, and a lot of businesses have them. But a pension is just a guaranteed income for life, right? Mm-hmm. And someone's providing it. So it doesn't have an account value. You just get a check for life. And sometimes the checks are adjusted for inflation. You'll hear that referred to as COLA, cost of living adjustment. Mm-hmm. And sometimes it's not. You may get $5,000 a month, and that's $5,000 a month for the rest of your life, Ron, whether there's inflation or not. So they're all different. But they're usually income for life, right? Mm-hmm. A great example. Yeah, a great example would be, a lot of people don't think of it this way, but your Social Security check, Ron, mm-hmm. it's a pension.
Yep.
Right? If I asked you, hey, what's the account value in your Social Security account? It doesn't have an account value, right? It's $2,600 a month maybe, right?
Yep.
And you're going to get it forever. So that's a pension. So somebody who got, for example, a pension from their work, and then they and their wife both have Social Security checks, they in effect have 3 pensions in retirement, don't they?
That's fantastic. Yeah, really
okay.
Good.
So that's what a pension is, right? And we see them a lot because we're in this Northern Virginia area. So a great deal of our clientele are retired military or retired federal government or state government. And they all get pensions for the most part.
Yeah.
Okay.
The rest of us are on our own, but these pensions really provide a lot for the people who have them.
That's exactly right. So a takeaway there, just a quick segue, if you are on your own there and you don't have a pension and you wish you did, there is a way to turn part of your 401k or IRA into what we call a private pension. You can create your own pension. Mm-hmm. So don't think because you weren't lucky enough to work for the government or for an employer that offered one that, now you kind of just have to cross your fingers and hope. So if that's the case and you say, hey, just make a note as you're taking notes today to get with Dave or your financial advisor and say, what about a private pension? Can I take advantage of that? Got it?
Yep, got it. And let me jump in here and give everybody your phone number. So if they want to talk to you about this specifically with their situation, it's 540-720-5656. 540-720-5656. That is for ILG Financial. Okay, sorry to interrupt. So let's get back to talking about the pension and this couple's retirement.
Yeah, so let's look at this real-world example with this couple. So they're a married couple. They've just retired. This example, they're 63. Again, do not get caught up on these numbers. It's very hard to follow this on the podcast. They're 63 years old. They're retired, and they've got a pension of $120,000 a year. No cost of living adjustment. So that's going to be $120,000 a year for the rest of their life.
Fantastic. Yeah.
In addition, they both, at 67, they plan to turn on Social Security checks. For them, that'll be another $68,000. So we're, right at, $190,000, right? for income once they hit 67. Okay,
that's a great situation.
Yeah. Now they also have savings. They put money away in savings. They've got an investment portfolio. This couple of about $1 million. Okay, 700,000 of it is, think of it like a 401k in a tax deferred bucket. 200,000 of it's in a taxable bucket. Just think of it as a regular brokerage bucket. And the 100,000 is a Roth. So they've got money in a 401k, they've got money in a Roth, and then they've got money in a regular account in addition to their pension and Social Security.
Yeah, these folks are in great shape.
Great shape, right. Their investments, now here's one that most people have never heard of, right? And this is a great example of why a financial advisor can add value that you don't even know that you need. Ron, have you ever heard of the term asset location?
I've heard you talk about it, I think.
You have, haven't you? So all that means is that you may have a certain amount of certain investments that you know you want, right? But what account are you holding them in? Because if every account is taxed differently, an IRA is taxed differently than a Roth, and a Roth is taxed differently than a traditional regular account called a non-qualified brokerage account. Is there a better account to hold one asset versus another? The answer is absolutely there is. Right? So one of the things we'll talk about is they are not using asset location, which most people do not, right? This couple has decided they want 60% in stocks, 40% in bonds, and they've got that portfolio spread out in all of those three accounts that we mentioned before. Make sense?
Right, yeah.
Their Roth is 60-40, their traditional account, their brokerage account 60-40, and their deferred 401k is 60-40. All the same investments. They're averaging about 4% in the bonds, the 40% bonds. We're going to assume they're averaging about 9% over long periods of time in the stocks. Don't know that they can do that, right? That's just an example. So between the two, if we did the math, they'd average about 7 total.
Okay,
a lot of numbers, but getting the picture?
Yeah, I like the sound of that. Yeah.
Okay. So $150,000 is what we think their budget is, meaning that's when we say budget in our office, that's what they need to live off of. So they've got almost $200,000 coming in. They need $150,000. Now they got to pay tax on that $200,000, right? So they have enough. When we do the math, they've got enough after taxes from their pension and their Social Security checks to cover this $150,000 budget.
Yeah.
Meaning they don't need their 401k, their Roth, or their individual account, their regular account. They don't need that for income. That's just pretty much sitting and growing.
I'm telling you, these folks are in great shape.
They're in great shape, right? And for our example, they're going to say they live in Florida, a no-tax state. So we're only talking here today for ease of this discussion about federal tax. Okay? So that's where we are. Now, let's look at I don't know what I don't know. Ready to jump into it?
Oh, yeah. Okay. Exactly.
Between their pension and their Social Security, they have another income that's going to hit, and for them it's going to be for them it'll probably be about age 75 under the new tax law. They have to start taking required minimum distributions from that tax-deferred account.
True.
Right? It's called RMDs.
Yeah.
Whether they need the money or not, they've got to report it as income, right, and then pay tax on it. They can reinvest it if they want, and they will in this example because they don't need the money, but it's going to create an extra tax burden, right? And as that happens, the extra tax burden will trigger extra Medicare costs for them, called a Medicare surcharge. Right? And over their lifetime, it would trigger over another $87,000 in Medicare charges for them because they earn too much.
A lot of people don't think about all this kind of stuff.
Yeah, now in theory, that's not bad. They're still fine. They're making a fortune. Why not pay? That would be the argument, right? What are you complaining about? You've got to pay more, but you've got plenty. But that's just the situation, right? They're projected by age 90 to leave about $1.9 million in their tax-deferred account to their heirs, right? That's the money growing, and that's even after they took out RMDs. Now, what's the problem there? Well, when the kids inherit that $1.9 million, they've got 10 years to take the money out over a 10-year period. They got to take it out each year over a 10-year period. And they'll pay tax on that $1.9 million at their ordinary income tax rates.
Yeah.
So that's a problem because their income, they've got the pension and the Social Security. These RMDs are just being reinvested. They can't put it back into the 401k, so they'll put it into their regular account. Now, their regular account keeps growing. They'll be paying tax on any dividends or interest that they get. But if it's in stocks, for example, Under current law, and this may change, but under current law, the stocks have what's called a step up in basis, Ron, which means the kids could inherit the stocks and not pay any tax on the stock gain. Mm-hmm. But they'll still be paying tax on dividends and interest, and that bond interest will be taxable as they go throughout their lifetime.
Sure. Yeah.
Okay. In this example, they're never going to touch the Roth. They don't need the money. It's tax-free. That'll go tax-free to their kids and keep growing, which is great, right? Mm-hmm. So here's based on just the numbers I gave you, which I hope no one's trying to follow all the numbers. Remember, keep the big picture in mind, right? Under that scenario, these folks just let this thing ride. They'll have a fine retirement. Be clear, they'll never want for money in this scenario, right? But their after-tax wealth at age 90 is $2.4 million. Mm-hmm. Okay? Assume that their taxable account is losing about 10%, right, in tax because of some gains, like I said, dividends and interest on bonds and things like that. Their tax deferred's going to be facing at least probably a 24% federal tax, their kids when they inherit it.
Yeah.
You see the problem there?
Yeah.
So they're going to have a huge tax hit on that. But they could improve the situation. And I'm going to give you two examples. One is by using what we call asset location, which I mentioned earlier. Mm-hmm. And the other is going to be annual Roth conversions, right? Okay. So want to take a look at them?
Yeah, please do. And I'm trying not to get caught up in these numbers too. And I'm thinking, this is an optimal scenario here where these folks don't have to worry about state taxes either. I mean, you're talking about just federal taxes, but not state taxes. So again, this hypothetical couple lives in Florida, right?
That's right. And you know what, you're right. This is tough because it seems like a lot of a number. So I keep going back to this, keep the big picture. So far, the big picture is they can live off the pension and the Social Security checks, mm-hmm. right? And they've got, what do we say, about $1 million that's going to sit and grow over the rest of their lifetime.
Fantastic.
They probably won't need it. It'll probably just go to the heirs, right? Yeah. And what we've seen so far is because they're just doing nothing, there's just some stuff that they would never even know that they could have fixed, like they're going to be paying more Medicare tax than they needed to. Mm-hmm. Just because they didn't know one of these strategies, I'm going to show you.
Yeah.
Right, and their kids are going to lose a lot of this inheritance to taxes and they could have prevented it. That's what we're going to show you.
Well, Dave Lopez is going to talk about what this couple should do here on the Retire Your Way podcast. Dave, what kind of strategies do you have in mind?
All right, so strategy one is called asset location, and I promised you before I would explain that. So in this example, remember we said that they have for their three buckets of investments, 401ks, Roths, and traditional, and they're all taxed differently, correct? Mm-hmm. Okay, well, remember we said they were going to have, in bonds, they were going to have about 40%, and they were going to have about 60% in stocks. And we said the bonds, we were projecting to earn a lower return of about 4%. And we thought the stocks were going to earn about 9%. So when you average them, it was about 7%.
Right.
Okay.
Right.
So here's the what we mean by asset location. Instead of just having every account have that same allocation of, let me get it right, 40% bonds and 60% stocks. Mm-hmm. Since the IRA is the bucket that gets taxed the worst, ordinary income, let's put the bonds in that bucket, because it'll grow the slowest, right? And the stocks that are growing at 9%, we want those in the, what do you think? Do you have a guess? We want those in the Roth because it's never taxed.
Yeah.
Right? And we want those in the regular account that, remember I said, gets a step up in value. So the tax gains of the stock price isn't taxed.
Yeah. It's a very simple thing you can do to really make a big difference.
It's incredible. And remember, in this example, you haven't changed your investments at all. Mm-mm. All you've changed is where you're holding the bonds and where you're holding the stocks.
Yeah.
Right? So let's look at what that would mean for them. Just that simple move over time, the couple's taxable required minimum distributions over their lifetime would have fallen by $172,000, which means they would be paying reduced taxes during their lifetime.
Yeah.
Okay. Their annual tax savings starting at around age 73 would drop by about $480 a year, which is next to nothing. Mm-hmm. But by the time they're 90, they'd be saving about $5,900 a year in taxes.
Wow.
Okay. Get this. Their inherited tax liability from the tax deferred account, meaning what the kids will have to pay in tax on the 401k, drops by $323,000.
Wow.
Okay, the taxable account, the one that's taxed as you go, that they pass on to their heirs, remember, and you get a step up in basis on that one, so you don't have to pay tax on that bucket. That bucket's worth $191,000 more than in the first example. So that's $191,000 we didn't have to pay tax on if it had been in another account. And their tax-free Roth account, which the kids don't have to pay tax on, $226,000 bigger because we're using the stocks in that bucket and it grows bigger. Get this, the Medicare means testing, that's unchanged because we're still taking the money out. We still have the higher income. Right? But their after-tax wealth at age 90 rose by $152,000. So now they're up to $2.6 million in after-tax wealth at 90 versus where we were before. So just one change, little change, no changes in what you're invested in, just where you held the bonds and where you held the stocks. Again, don't get caught up on the numbers. You see, we lowered their taxes over their lifetime and we increased their net worth by age 90.
I'm amazed by this example here. So at the surface here, it appears that this couple was already set up pretty successfully for retirement, but just implementing this one single strategy, asset location, seems to yield pretty impressive benefits.
With no extra risk, right? Because we haven't changed the investments at all. And this is the perfect example of what you said when you started, and I appreciate you mentioning it, Ron, which I don't know what I don't know. Why wouldn't someone do this? I didn't even know I could do it.
Yeah.
No one even addressed I didn't even have the idea to maybe consider splitting the bonds and the stocks into different accounts.
That's precisely why somebody, out there listening to this show today, maybe they hear themselves in this example. That's precisely why you need to call Dave Lopez and have a conversation about it.
Yeah, well, I appreciate it. And you're right. When people look at it, you have to get past the idea like, well, they're already going to be fine and they're going to be fine anyway. And they are. But whether you have a net worth of $100,000 or $100 million, that's no reason not to take advantage of every opportunity that you have to legally maximize your returns and minimize your tax liability.
Yeah.
Right?
Yeah, you may as well take advantage of the rules, the way they are.
That's exactly right. And this is about having somebody walk you through and saying, hey, by the way, were you aware of asset location?
Yeah.
In your particular case, this could work. It doesn't work for everyone. Hey, let's jump to strategy 2. Sound good?
Okay. Yeah. So far, you've talked about people who may have a lot of money slipping through the cracks they're not even aware of, and that they can change that whole scenario. But you're going to lay another planning strategy on us?
Yeah, so strategy 1, what we said is we saved them taxes, we increased their net worth without any extra risk, and we gave them the ability to pass more to their heirs with just one simple change, asset location. Now, the second strategy is called, many people have heard of this one, Roth conversions. And that's just a simple strategy of saying, hey, I'm going to pay tax on some of that tax-deferred 401k now and move it into a Roth account so that as it grows, it'll never be taxed again.
And we know that in the future, taxes are very likely to be a lot higher than they are now.
Yeah, so as taxes go up, it's very easy to decide if Roth conversions are for you. If you believe that when you take this money out later in life or when your kids inherit it, that it'll come out at a higher tax bracket or a tax rate, right, because of rising taxes than you're in now, then you're almost always, I don't like to do absolutes, better off paying the tax now. That's no different than saying, hey, I need a new barbecue, but not for a year, right? If you know you need it, if you can buy it cheaper and you're guaranteed that it's going to cost double in 2 years, you might as well just bite the bullet, pay for it now and store it.
Yeah.
Right?
Yeah, that's true.
It's on taxes for all intents and purposes if you believe, which we do, but you have to make your own decision. If you believe taxes are going up and going up dramatically over the next 20 or 30 years, then in effect, taxes are now on sale. So Roth conversion gives you the ability to say, look, I'm going to settle up with the government right now while I'm still in the 12% or even the 22% tax bracket, so I don't have to pay taxes later in a 15% bracket or a 30% bracket, right?
Okay. So give us an example here, a good reminder of what Roth conversions are, because there's a lot of misinformation out there.
Yeah, so Roth conversion is you can do it on money that's inside of your IRA or your 401k, your traditional that you have not paid taxes yet, right? So what the government lets you do is they let you take that money and just move it. So let's say you take $100,000 from your 401k, Ron, and we're moving it to a Roth IRA, which a Roth IRA is never taxed again.
Yeah.
Okay. Now, the price for that is you've got to pay the tax now on that $100,000 because you've never paid tax on it.
Sure.
Right? So what happens is you take the $100,000 out, and in the example with this couple, they'll move the entire $100,000 from their 401k to their Roth. And then they'll use some of their other money. Remember the regular account they've got, the non-qualified? They'll take money out of that account to pay the taxes. So if they owed 20% in federal taxes, the $100,000 moves from the 401k to the Roth. And then they take $20,000, they reduce the account value of their regular account by $20,000 to pay the tax bill.
Okay. All right.
Right. So that's a Roth conversion. So in this example, this again, no one size fits everybody, but we are going to use the Roth conversion. Now, unfortunately, with this couple, their pension and income means that they have less flexibility to implement a Roth conversion. All that means is they're already have used up probably the first lower two tax brackets. But we can use it a little bit but if they use the Roth conversion, they are going to still trigger this Medicare testing and bump up the Medicare tax. Right? So we've got a Medicare means, tax means at age 65, based on the income that you have the prior 2 years, they decide how much you have to pay for your Part B Medicare.
There is no way the average person out there is going to know all this kind of stuff. So, I mean, I'm learning just by listening to this, what you're saying, and I know everybody else is too.
Yeah, I know, and I know, just be aware if you're listening, it does sound confusing. You don't have to remember this from the podcast. All you got to remember is, hey, do I need to have Dave or my financial professional look at our situation and see if we can save some money?
Yeah.
Right? So this couple, while they're converting, right, over the years in the beginning here, while they're moving some money from their 401k to their Roth, they've got to record that as income. And during those years, they're still going to be paying that extra Medicare bill, right? Okay, so in this example, from years 63 to 66, we're only going to convert about $40,000 a year, $160,000, to avoid the Medicare testing. So now let's implement this strategy, right?
Okay.
Even though the Roth conversion in this example is relatively modest to try to avoid the Medicare thing, it still hits a huge impact because they happily earn in retirement about 9% in their stock accounts, right? So the couple's taxable RMDs throughout their entire retirement, their required minimum distributions fall by $722,000, which reduces their taxes later in life.
Whoa.
Right? Amazing, huh?
Yeah.
Their annual tax savings is reduced. Remember how I said it was reduced in the previous example with asset location? Well, this reduces their taxes an additional $2,800 at age 73. And by 90, it reduces it an additional $10,400 a year.
That is amazing.
Right? Remember, all this is in addition to the asset location strategy, not instead of. Right? The inherited tax liability that their kids would take on, right, falls by an additional $588,000.
That is incredible.
Right? The taxable account, right, the one that's taxed as you go, that they'll pass on to their heirs with a step up in basis, that account falls. The taxable account balance falls by about $861,000. Now, why did that fall?
Yeah.
Because they took out money out of that account to pay the tax bill on the Roth conversions.
Man,
right? But
you're talking major strategy here. This
major
is great.
strategies. Yeah, we paid it, but we paid that taxes. Those taxes were due anyway. We just paid it at a lower tax rate by paying it early, right?
Yeah.
So takeaway, their tax-free Roth because of the conversion that they'll pass on to their heirs, $1.5 million when they pass at 90.
That is amazing.
The $87,000 that they would have had to pay extra in Medicare means testing, eliminated. The after-tax wealth at age 90 rises by over $350,000 to over $2.95 million.
That is amazing. So you've got this couple that is already in good shape to start, but you have implemented these couple of strategies, and their improvement, I mean, it's light years in improvement. It's amazing.
It's light years. And here's the big takeaway, which is the difference between, some advisors, all they do with advising, and this is how our industry's set up, is I'm going to help you decide how much you want in stocks and how much you want in bonds. right? And that's their job, and that's what most people think their job is. But when you have a firm like ours, a comprehensive firm, our position is, I don't know how I can instruct you on one without knowing what the other stuff is. So here's an example where we're saying, this couple, I might say, look, I kind of like your split of stocks and bonds. Let's not touch that. What if I can still save you money?
Yeah.
And we're not even changing, and this is where folks say, I don't know if I need a financial advisor. I can manage my money on my own. You may have picked a great investment strategy, right? A stock and bond split. But even if we are advisors doing the same split, just having a coach, another set of eyes saying, but we can do this at the same time and make you an extra $350,000 with no extra risk whatsoever. Don't know what you don't know.
Pretty incredible, Dave. I love it. You know, this is amazing. I mean, it's really educational for everybody listening out there. And, they need to call your office and set up a time to talk about all this kind of stuff.
Yeah, and the challenge, I would say, I don't want to scare anyone, but all the stuff we just talked about gets even more pronounced if we think taxes are going up over time. Mm-hmm. Right? So think of it as the stopwatch or the hourglass is dropping on the time we have to take advantage of what are actually historically low tax rates. So if you're worried about how that works, you don't know how your plan fits in, or if you could take advantage of strategies like that, you don't have to know. Right? Just get with your financial professional, ask them if they do comprehensive planning that includes, tax forward planning like our firm does. Right? In addition to the asset management stuff, ask them if they do asset location planning in addition to just diversifying into stocks and bonds and other stuff. If they don't, find someone who does. If you're not sure of one, we do. Give us a call. We're glad to help in any way we can.
And that number to call is 540-720-5656. Income, legacy, growth. It's all right here at ILG Financial, and it's about helping you plan for retirement your way so you can achieve your financial goals. And it's amazing the differences that Dave Lopez and his team at ILG Financial can make. So call ILG Financial at 540-720-5656 or go online to ilgfinancial.com and you can learn more. This is the Retire Your Way podcast with ILG Financial. Dave, it's been a lot of fun talking to you today. I learned a lot, and I'm certain that everybody else did too.
Hey, my pleasure too. Always love getting together with you, Ron.
Join us again next time on the next edition of the Retire Your Way podcast with Dave Lopez, ILG Financial. The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and do not necessarily represent the views of the Alpha Star Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through Alpha Star Capital Management, LLC, a registered investment advisor. Alpha Star and ILG Financial, LLC are independent entities. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability.